Good afternoon. I'm here with Mark Lindbloom, who is a portfolio manager for Western Asset Management. And I have the pleasure of talking to Mark, who works on WBND, which is the #1 performing fixed income bond fund. So tell me about that and tell me about the track record.
Well, we're quite pleased for the first full year that we are #1 in terms of performance, obviously. There's a few things that contributed to it, and I'll just list them quickly. The first has been that we have had a longer duration of the portfolio, greater interest rate sensitivity. The reasons we have done that is inflation is low, but also it acts as a good buffer in the portfolio in case we see stock market volatility or widening in spreads. The second thing that worked very, very well for the ETF was our dedication to corporate securities. And as you know, it's getting a lot of heat in terms of why do you want to own a corporate security? Debt's increasing, leverage is increasing, triple Bs are a problem, et cetera. And we stuck with it for most of last year until the fourth quarter because we thought it was attractive value proposition for our ETF investors. And the third thing that worked very, very well, hard to find anything that didn't work well last year, was emerging markets. Both dollar as well as select local emerging markets that performed very, very well. After a rough night, 2018, 2019 was indeed a very, very good year for the ETF.
Okay, and where do you see opportunities ahead?
A little bit different this year, and I'll go through the same list. On the duration side, we still believe that inflation is going to stay low, and we still believe that high quality sovereign debt acts as a diversifier to a portfolio. And the last week is proof of that, and you've seen a lot of scares about viruses and things that go around the world. People fly to safety, they flee to safety. So we very much want to have that long duration. The second thing I mentioned are corporate bonds, and we've changed our tune a little bit there, not because we expect to see economic growth slow, but the valuations on corporate bonds, both investment grade and high yield, are not that attractive in our opinion, and we've reduced the allocation to those sectors. And then the third one, we have stuck with emerging market. We still feel real yields are quite attractive compared to the rest of the world. And we still very much like select emerging market countries as part of our broad market portfolios, and specifically WBND.
Great, and do you want to add anything on volatility?
Volatility has been exceptionally low, as you know. You look at the bond markets, you look at the currency markets, you look at the equity markets, just by every measure you see a volatility being quite low. We don't expect to see a sharp spike in volatility until we start to see significant changes in economic growth and inflation and a response from central banks around the globe. So we would say that yes, it could go up. For example, right now interest rate volatility is going up because of the scare over viruses. But generally speaking, we think it's going to remain fairly muted in 2020.
Great, thank you.
Thank you very much.